Hey everybody, Kevin Burgess again with yet another video. Today we're going to talk about a utility in Arizona who has, to be honest with you, come across some pretty tough times lately. However, this utility appears to be trading at a 8% discount, but yet has a market smashing 5% yield. If that's something you're interested in hearing more about, stay tuned. This is the second in my series of looking at companies who are the largest holdings in my portfolio. So the company we're talking about today is called Pinnacle West Capital Corporation. They're out of Arizona, and I'm going to go through some slides here that'll talk about a lot of things regarding the company. And if you like this kind of content, please give this video a thumbs up and subscribe to the channel. It would mean the world to me. So with that said, let's get started. Pinnacle West Capital Corporation began in 1884 when the company was first created as a small municipal utility to provide electricity and heating to the people of Phoenix. Today, this regulated utility company focuses solely on providing electricity and is the largest public electricity provider in Arizona, serving over 25% of the state's households. Here's an overview of the company's service territory in Arizona. You can see that they cover much of the metropolitan areas of Arizona. On the right-hand side, you see that the consolidated assets at the end of December of 2020 were around $20 billion, revenue of $3.6 billion. At that time, the market cap of this company was about $9 billion. They are now at about $7.9 billion, which is a reflection that the stock price has decreased. The industry is a utility. It provides electricity. They're the largest public provider in Arizona, and they have a protected service territory. Their rates are governed by the Arizona Corporation Commission for Generation and Distribution and the FERC, Federal Energy Regulatory Commission for Transmission. You can see that about 79% of their rates are governed by ACC and about 21% by the FERC. In terms of competition, it is rare to have competition within a utility service territory, which is why their rates are governed by the Utility Commission. In terms of segments, they only have one. They have a regulated electricity segment. It's the traditional regulated retail and wholesale electricity businesses and includes electricity generation, transmission, and distribution. Its competitive advantages are that it has a service territory monopoly, as well as efficient economies of scale. In terms of risks, every business has risks. The risks for Pinnacle West relate to regulation, legislation, and operations. In terms of regulation, they're regulated in both their rates as well as their environmental emissions. In terms of legislation, any kind of lawsuits and things like that would be an exposure to the company. As well as their operations, they do have the largest nuclear facility in the country, so there's a risk related to that. How do they manage these risks? Well, let's talk through the rate regulation risk. Pinnacle West shares tumble after regulators slash returns in rate case. I thought this was an interesting quote by a Guggenheim analyst who said the Arizona Corporation Commission, or the ACC, is now confirmed to be the single most value-destructive regulatory environment in the country. And he goes on to say that the ACC does not appear to take a cooperative approach to the companies it regulates, and worse, seems to misconstrue the fundamentals of utility rate making. So there's a large risk here for this utility. I believe one of the challenges for a utility is its relationships with the regulators. And in this case, Pinnacle West is obviously at odds with its regulators. In terms of rate regulation, they just had a rate case come out in October. The rate case outcome was disappointing. And this material came from the company's website. They sought for an increase in revenue of $169 million. They ended up getting revenue decrease of $4.8 million. In terms of return on equity, they sought a 10% return on equity. However, the ACC ended up giving them only 8.7%, which is a significant decline. So how are they going to manage this rate regulation risk? Arizona remains among the fastest growing states in the U.S. You can see the population growth, the housing growth in this area. It's phenomenal. So as the number of houses grows, there will be more demand for their product, which will drive further demand for the product provided by Pinnacle West. In addition to that, their service territory focuses on high-tech growth and economic development. These high-tech data centers need a lot of electricity. As those data centers come into this area, it will also drive additional load. They're estimating up to 640 megawatts of capacity by 2035. The management team has no plans to issue equity before the end of the next rate case. Looks like that may be through 2024. So that's a good sign. That's a good thing for investors. However, it is important to point out that they could issue equity at the end of that period of time. They will obviously, as you can tell by this slide, incur more debt during that time frame as well. We'll talk about why that's needed here in a few minutes. Environmental regulation risk. They are transitioning to a clean technology. By 2035, they plan to have zero coal in their portfolio. So for those who are interested in clean technology and in a cleaner environment, they're making the right steps toward that. According to the company, they have a clear plan for clean energy transition. This will obviously take funds. It'll take capital to do this, which is one of the reasons that Pinnacle West will likely incur more debt and more equity in the future. In terms of capital allocation, you can see that the dividend growth over the last 5 years has been a really nice 6%. However, related to this rate case, I would not expect that type of growth over the next 5 years. It'll be much slower than that. The latest increase was 2.4%. And the company, in my opinion, raised the dividend by 2.4% to let investors know that they are serious about continuing to grow their dividend. And dividend yield is now 4.86%. You can see that shares outstanding are pretty flat. They've grown just a little bit over the last 10 years by maybe 3 million. So that's not significant. But it's important to point out that this could take a step higher depending on how the rate case comes out in 2024. The earnings payout ratio is jumping to 83%. So why is that? Management has decided that they are going to continue their dividend as is and even increase the dividend by 2.4%. What that does is it puts pressure on the earnings payout ratio. The theory here is that the growth that's being seen in Arizona through increasing population as well as these data centers is going to cause the earnings of the company to grow as well, which will eventually bring this payout ratio back into its normal range. They're thinking that's probably going to be in the 4 to 5 year time frame. Earnings per share, you can see has, this is from Simply Safe Dividends. They're saying it's $4.10 for the next 12 months. It's actually more like a midpoint of $3.90 per the company's 2022 guidance. So it's a little even worse than what Simply Safe Dividends says. The free cash flow, let me talk about that for a utility for just a second. Free cash flow for a utility is typically negative. And the reason that is because a utility makes money by investing money. And so they will invest money from shareholders, they'll invest money from debt holders to produce a return that goes back to shareholders through dividends and through price appreciation. In terms of credit rating, they maintained a BBB plus credit rating, and their dividend safety rating is 70 out of the 99 scale that Simply Safe Dividends has. Its projected growth and earnings per share is 5 to 7% off of this new 2022 number, which is that midpoint of $3.90. They believe there's long-term potential upside. They have these SCRs that were not allowed in the last rate case. They're looking to accelerate clean energy transition, which would create more capital invested for them to get a return on. They're driving sales and growth through their economic development, and they're managing their costs well, and they're trying to reduce regulatory lag. And what regulatory lag is the difference between when they actually incur costs on behalf of their ratepayers and when they actually recover the revenue from the ratepayer. So they're looking to reduce the time between when they actually spend money and when they collect it from the ratepayers. They are maintaining a robust capital program. This is essential because of what we talked about a little bit ago. If they don't invest money, they don't make money. It's important to understand that they are keeping a strong capital plan in place for the 2022 to 2024 time period. They're expecting their rate base to grow. Their rate base is part of what they get recovery of and return on in their rates. In terms of valuation, Morningstar has it valued at $77. The last close was at $70.50. This is roughly an 8% discount. Also, in the price targets for Seeking Alpha, you see the average price target is $67. This doesn't appear to be that appealing because the current price is $70. So why would I buy it at $70 when in a year it's going to be $67? And that's a great question. I don't have a great answer for it. The challenge here is, is this a fair value for this business? And if it is now the time to invest at an 8% discount because you're getting a 5% yield just for being patient. So in summary, Pinnacle West is a regulated utility in a difficult regulatory environment. It's a fast-growing population in the country. The load demand from technology is growing. They have a solid balance sheet and credit rating. This investment, though, will require patience. It'll grow from an organic population and technology growth in the medium term, but there is a possibility of a better rate environment in the future. So this investment is going to require patience. More than likely, still got some turmoil to go through, some uncertainty to go through in the next 2 to 4 years. But in the year 5, maybe there is some hope on the horizon. So in the meantime, I'm getting a 5% yield while I wait. So they are the highest yielding utility that has at least a safe dividend. So Pinnacle West is not an investment for everybody. I like it because I believe that the long-term prospects for Pinnacle West are actually very good. Why is that? I believe that they're in a place where their commission can't treat them any worse. Longer term into the future, I think that this may be a great investment. And in the meantime, I get a 5% yield. Just some disclaimers. I am long in Pinnacle West. I am not an investment professional. This video is for your entertainment purposes only. I'm just sharing my opinion on a stock that I have in my portfolio. So I hope you like this kind of content. If you do, give the video a thumbs up. Subscribe to the channel. And our next video in this series is going to be regarding Lockheed Martin, which is the 3rd highest holding in my portfolio. So with that, I hope you have a great weekend, and I will see you in the next video.